Okay, so for our first example, I've put together an income statement for a fictional bike repair shop under the name Lincoln Bike Parts. Now, before we get into this exercise, this class contains several documents which are available for download, and you can find these in the resources folder off to the right side of your screen. So if you'd like to download this resource for yourself, go ahead and pause the video now and download it so that you can follow along. Now, remember from the previous lesson that income statements are a record of the value generated or lost over a period of time. The time period that we're analyzing here is the year ended December 31st. So that's always the first thing that I check when I'm taking a look at an income statement. Companies will always publish their financial statements on an annual basis, but they often put them out on a quarterly or a monthly basis as well. So again, this is just the first thing to check when you're analyzing an income statement. Now, the first entry on this P&L is revenues at about $1.7 million. And then directly below revenues, we see COGS. And what this stands for is cost of goods sold. Now, what is cost of goods sold, you may ask? By definition, cost of goods sold are the direct costs related to producing goods or services. And in the case of a retail business like this one, cost of goods sold refers to the cost of inventory. Now, in this case, we have 4 unique inventory categories, each of which are reflected on this P&L. Now, for example, when the business sells a wheel, the price that the business purchased that wheel for is reflected on the income statement as cost of goods sold at the time of the sale. When we think of cost of goods sold in terms of debits and credits, the journal entry would look something like this, with cost of goods sold being the debit and inventory being the credit. Now, remember from our previous lesson on debits and credits that expenses are debits and a reduction in asset is a credit. So when that inventory gets sold, we record a credit to reflect the reduction in inventory. Now, moving down the P&L, we subtract total cost of goods sold from revenues and we get what's called gross profit. Below gross profit, we have several other operating expenses which are broken out into individual line items, and this is very common when you're analyzing small companies like this one. So an operating expense is any other cost that a business incurs during an operating period. Most of these are pretty self-explanatory, like rent and utilities, but there are a few in particular that I'd like to highlight for you. And we're going to start with the expense called amortization. Now, amortization is what's referred to as a non-cash expense, which means that it reduces net income, but it has no impact on cash. Now, amortization reflects a business's use or consumption of intangible assets with long-term lives. Depreciation is another non-cash expense, but instead of intangible assets, it reflects the use of tangible assets like real estate or equipment, which also have long useful lives. Non-cash expenses are especially important from a financial modeling standpoint, and I've dedicated an entire lecture to this concept later in this section. Now, the next expense I'd like to highlight for you is interest expense, which reflects interest paid on debt. And what this expense tells us is that there's some type of loan or credit line on the balance sheet, so we'll be on the lookout for that when we analyze the balance sheet in section 4. Now, the last expense that I'd like to specifically highlight is the one-time expense of $30,250. One-time expenses are extraordinary or non-recurring in nature, and they occur in addition to standard operations. So some common examples of non-recurring expenses might include weather damage, loan fees, unusually high attorney's fees, and so on. Businesses often separate non-recurring from recurring expenses to reflect that the non-recurring expenses are just that, not typical in nature. Now, again, this concept will become more important to us when we discuss financial modeling later in this section. When we subtract total operating expenses from gross profit, we get net income, or what's commonly referred to as the bottom line. Now, net income is a measure of how much value was generated or lost during that accounting period. This figure is linked to the other core financial statements in a number of ways, including in the retained earnings calculation on the balance sheet and in operating cash flows on the cash flow statement. So now that we've taken a look at a private company's income statement, Let's also take a look at a public company's income statement. I'll see you in the next video.